Hi everyone. We're here to talk about stock of the month today, and with me I've got Lucas Goode, our telco analyst for our large and small cap funds, and it's quite an opportune time, I guess, to talk with you because today we're going to talk about not just one stock but two. We're going to talk about Telstra in our large cap funds while we own it, and TPG in our small cap funds. So, Lucas, why are we so positive the telco sector at the moment?
So to kick things off, I guess first I'll start by saying that telecommunications companies tick a lot of the boxes that we at IML look for in our investments. They are the original recurring earnings businesses in some ways. It's highly non-discretionary. I mean, in the hierarchy of needs, telco, your monthly phone bill probably sits only below rent and shelter in the hierarchy of needs. It's a heavily concentrated industry. There are only 3 full-service operators in the country. And also you've got an industry that's going through a period of significant market repair. And the other thing as well, in that you do look for some long-term growth. Well, the population is usually growing, and that means that the number of telco services is usually growing as well. It didn't quite work that way during COVID, but we're coming out of that now. But I think the market repair is the key point that we wanted to touch upon today, and why we think that right now TPG and Telstra both make good investments. And I know Dan, it's something you've spent a lot of time looking at with your Telstra position.
Yeah, I think it's fair to say the telco industry went through a pretty extreme price war, probably starting around 2016, 2017. And we saw prices across the whole industry fall for several years in a row. And it was pretty devastating, I guess, for industry returns. And we saw industry returns get to around sort of 1 or 2%, which is just well below their cost of capital for the industry. And that led to some consolidation. And we saw in around 2020, we saw the merger of TPG and Vodafone.
Agreed in 2018, actually, but the ACCC held it up for a while.
Took a couple of years.
Yeah, I got there.
And Amasim and Optus got together. And when that industry consolidation occurred, we started to see some more rationality. And we started to see prices start to tick up, around 2020, 2021. But still today, the industry returns are very low, around 2%. And we still think there's quite a long runway for positive price growth going forward.
Yeah, I think that's absolutely right, Dan. It's an industry that has really struggled to earn its cost of capital back. Now, part of that was due to the NBN, which I'm sure you'll talk about because it really impacted Telstra. But also, a lot of it was self-inflicted. As you say, there was a price war that lasted about 4 years. There were no winners. There are never any winners in a price war.
No, that's for sure. And it is, we do quite a lot of company contact, and what's been really pleasing over the past sort of couple of years, we're seeing a lot of incentive plans for management change. In the past, they were really focused on winning market share, and today it's really focused on improving returns and improving profitability. So that's why we're pretty positive. This sort of market repair on prices has many years to go. In regards to Telstra, why do we specifically like Telstra? Apart from the dynamic of improving pricing for the whole industry, there's quite a few reasons why we like the business. NBN has just been such a huge headwind for them over the past several years. It's been a $3 billion headwind to earnings. That is now essentially complete. So that $3 billion headwind is done, and going forward, the business should deliver pretty good earnings growth, really from that mobile business predominantly. So that's sort of a key element. The second thing we like about the business is they own some really high quality infrastructure assets, which we think are sort of undervalued in the share price. And probably the best one to highlight is their NBN rental business, where they rent to NBN all the pipes and ducts, which the fibre goes through. And that business earns $1 billion rental stream, which is paid by the government. And that
inflation protected,
yes, by
always
CPI
in these days.
And yes, I think this year the rent's growing at 6%. So that's quite a material driver of earnings right now, and a high quality earnings stream. And then probably the final thing is the costs of the business are really well under control in what's quite a high cost inflation environment. Telstra costs are growing much less than inflation. I think.
I think it was 1.6% they reported in the first half, and even more impressively from where I'm sitting is that they stuck to their T25 targets of taking $500 million of fixed cost out of the business. Now they set those targets before inflation took off. So I think it's really testament to the management team at Telstra and the operational efficiencies that they've managed to drive within that business.
Yeah, so we see the industry having good price growth. We see they own some high quality assets, and the outlook for inflation, their costs is well under control. What about TPG? Why do we own TPG in the small cap fund?
Yeah, thanks, Dan. So TPG is a bit of a newer position. We bought in after the merger with Vodafone completed in 2020. And we like it for many of the same reasons that we like Telstra. I've obviously touched upon why we like the telco sector in general. Clearly, the price outlook for mobile is improving, and that's going to drive returns. Dan, you touched upon the costs. I think it's worth highlighting, given what's happening with wages, what's happening with inflation, that these aren't really people-heavy businesses. I think Telstra, it's about 30% of their fixed costs are people-related. That's not to say there isn't some inflation there and there isn't some inflation in other areas like equipment, but they're able to keep a lid on it. And with TPG and Vodafone merging as well, they've got their cost synergies to come through. So that gives another tailwind for them on the cost side. And I think the other thing that we should note with these companies as well is the Mocken deal.
Absolutely.
So Mocken, as I'm sure absolutely no one watching this is aware, stands for Multi-Operator Core Network. That's probably not going to clear things up a great deal. They love their acronyms in telco. Actually, every industry we cover, they love their acronyms. But what it really is regional infrastructure sharing between Telstra and TPG. Now, firstly, I think this is a big deal just for the industry. As we've touched upon, industry returns have historically been low. They're improving, which is why we think that it's a good place to invest. And infrastructure sharing is one way that you can sweat these assets harder. I mean, it really doesn't make economic sense for 3 mobile networks to all be rolling out poles, towers, all across Australia's sparsely populated rural areas. And so, therefore, they should work together. So TPG and Telstra, they've signed a deal where effectively TPG decommissions a bunch of its towers that it was really underutilising. It will roam onto Telstra's network in the regional areas. In return, Telstra gets, money from TPG, but also they get access to TPG spectrum, which is important for Telstra because as the by far number one mobile network, they do have more congestion on their network, and the spectrum will help alleviate some of that. So we see it as a real win-win for the two of them. It's particularly important for TPG because they have had a real network disadvantage outside those metro areas. And not only does that see them under index in regional areas, but it also impacts anyone who lives in a metro area but then travels a lot, whether it's for work, for pleasure. I mean, you really notice when your mobile phone gives you one bar and you can't make a phone call or look up Instagram. This will give them a product that they can sell in those regional areas. And I think it really is a win-win for the two businesses. It's clearly not a win for Optus, which is the real loser in this situation. But we think it's good for the industry overall as well. Now, the ACCC has come out in opposition to that deal. Telstra and TPG have appealed that decision. We think they have a very strong case. We should hear by the end of June whether they're successful. But either way, we still like TPG as an investment. We think it's undervalued. You also touched upon earlier, Dan, or maybe it was me, I can't actually remember, where we spoke about the fact that these companies benefit from larger subscriber bases over time because Australia's population is growing. Now, during COVID, that didn't happen. A lot of immigrants left the country. We kicked them out. But now that the borders have reopened, that will actually disproportionately help TPG. TPG lost more subscribers on the Vodafone network than their competitors did because they've always, as the lowest cost operator, as the challenger, they have over-indexed with new Australians, international students and the like. Therefore, they should disproportionately benefit now that the borders have reopened. So we do really like TPG for those reasons.
Thanks, Lucas. So I guess just to sum up, why do we like the telco sector? We really do see this price repair or market repair lasting several years in the future because the industry returns are so low. We like the general defensive nature of those earning streams. And we think that's going to be pretty well placed whether inflation remains high because they can control that cost base, or if the economy does fall into recession, those sort of very defensive earning streams are going to hold up quite well. So the stocks are pretty well placed in most economic environments.
Totally agree, Dan. Thanks for joining us.
Thank you.